everyone. Welcome to our first podcast in what will be a stellar series of very useful episodes for those of us who want to make it big in real estate investing. Here to help you get the information you need for the money and freedom you deserve is Ali Jamal, CEO of Stable Gold Hospitality, a real estate investment firm. It's amazing to see how Ali went from earning minimum wage, working as a cashier almost 20 years ago, to owning and operating a real estate firm that now owns 1,500 units throughout Metro Atlanta and generates $9 million in annual sales. Ali, tell us more about how you got here.
Yeah, so a little bit of background on myself. I'm originally from Vancouver, Canada. I moved to Atlanta in 2011 to open up my first hotel. And so basically how that story unfolded was I was working a corporate job back in Vancouver. I was working for an organization called the Canadian Manufacturers and Exporters Association. And at the same time, over the years, I was investing in real estate on the side as a hobby. Between the ages of 19 and about 27, 28, I had collected a portfolio of about 7 or 8 properties while working my corporate job. And, I was really looking at somehow moving over to real estate investing full time. So my accountant in 2011 was sitting down with me and she had said, look, there's a really good opportunity in the US right now. The market has basically crashed and you should look at, investing in some assets out there if you really want to make a go of this full time. So she connected me with a broker who specialized in hotels in southeastern United States. And from there, within the next few days, I had met with him in Atlanta, Georgia. There was a shutdown hotel that was basically sitting vacant for the last 2 years that I had viewed with him. And basically, the deal was almost just too good to be true. We were picking up about 127 units in fairly good condition for, approximately $1 million at the time. And so, we were just really excited about the potential deal. So obviously at that point, I didn't have, the money to invest in it, and it had to be a cash deal because no bank would finance an opportunity like that at that point. So I was lucky enough to call up family and ask them to invest in the project, and they really were just the angel investors and help me, acquire that first asset. So within about 2 weeks after visiting the asset, I had quit my job. I had moved to Atlanta, a city that I had never been to before. I was now living in the hotel, and I was able to talk my uncle, who was actually one of the investors, into coming to Atlanta with me to start the hotel. And all credit to him. He was, I think, about 72 at the time when he came with me. So, myself and him, 2 housekeepers, and a maintenance man opened the hotel. I basically worked the front desk for 12 to 13 hours a day, trying to get the hotel up and running. My uncle, for the first few months that he was there to help me get it off the ground, was handling operations. And obviously we had, a team of other people to manage everything else. And what we found is that the extended stay market, the daily, weekly, and monthly segment was really in demand, especially at that time when there was a need for affordable housing in Atlanta. And so, within about 12 months, we had been able to get the property into the black. It was profiting. Basically, the conversation at that point was, how do we expand? And obviously, expanding is a lot easier once you've had a track record of success. So once we were able to get that first hotel up and running and we're able to, get it to a profit center, raising capital from family and friends was a lot easier. So that's basically what we did. We started looking at raising more capital and purchasing more assets, and we just kind of went from there.
The first deal that you spotted was this old rundown hotel that was vacant. And you were still quite keen. You weren't sort of apprehensive to go ahead with that deal. Were there no red flags when you saw that property? I mean, most people would be seeing red flags. That would kind of inhibit them.
Yeah. So I'd say, number one, I think it comes down to personality type. I think to a certain extent, I'm a little bit of a risk taker. So I think when you're dealing in the world of C and D class assets, there is a higher level of risk. And so you have to have that appetite before you even enter into that kind of business. So I'd
Sorry,
say that.
what's a C and D class asset? What's that?
Let's talk about hotels for a second. So an A-class asset would be like a Ritz-Carlton, a new high-end hotel. Then you go down to like maybe like a B-class asset, which would be, maybe a Holiday Inn, a little bit older Holiday Inn. And then you go down to C, which is a hotel that's on its lower years of economic life, and that's in not the greatest condition. And then a D class asset is one that's maybe been shut down for a couple of years, really on the end of its economic life, and needs a lot of repair. If you're going to invest in these type of assets, there has to be an appetite for risk, number one. Number two, I would say, what I found right away when I went to the property initially is that the property next door was actually like the parking lot was overflowing. So, and they were an extended stay hotel. So I knew that if we had a similar business model right off the bat, we would be able to take a large percentage of their business as long as our quality was somewhat in the same sphere and our pricing was aggressive. And we were still able to maintain our operating costs because we were able to acquire the property outright due to the fact that we acquired it at a very good purchase price.
Isn't there a lot more capital that you need to have available to you? Because of course these properties are worn down, and if you need to kind of get them up to shape, then there's probably a lot of costs that come along with that.
Yeah, so I think it all comes down to how you want to invest, right? So if you're looking at a franchise model, and let's say a newer asset or a newer type of business, even if it's service oriented, not real estate related, you're just going to have a higher acquisition cost, right? So you're going to have to enter that business with a lot more money. Will your returns potentially be greater in the future? Yes, but it just depends on where you are and how you want to invest. So we've made a focused decision to continue to acquire assets that are very low acquisition costs, and basically we want to hold that asset for a long period of years, all while utilizing the profits that the property is making over those years and recycling it back into the property. And eventually we're hoping that we can get a profit out of the equity in 3 or 4 years after all the renovations are done, as well as continue to cash flow the property. And it's very easy to cash flow a property that you acquire at a very low price because your overhead is not going to be very high. And most likely, if you've acquired it right, you won't have to have a mortgage, or if you do have a mortgage, it'll be a very small one.
Okay. Give me an example of some of these deals that you're finding.
Yeah, so I'd say, across the country, there's so many deals that can be had. It's just a matter of, once again, risk tolerance and your ability to jump on a plane and go check it out. So I think people think regionally in their local cities, sometimes those deals can dry up, especially in markets like New York, LA, some of the larger urban markets. But if you look across the country, there's a lot of opportunity. So just to give you an example, we just acquired a property in North Dakota. It was a 96-room interior corridor hotel. It had been shut down for 2 years, but we ended up picking it up for $450,000. That's approximately $4,000 a door. That's less than replacement cost of the building. We're already sitting at probably about 90% occupancy. We're probably going to do top line of about $50,000 a month in revenue there. So, if you could do $500,000 top line on an investment you picked up for $450,000, that's a pretty decent return if you can manage your costs.
So did you say that you got this deal for almost $4,000 a room?
So it was $450,000, and that would break down to $4,000 per room. And there are deals like that across the U.S. if you look for them. Once again, this property was sitting on the market for almost 2 years. There's many people who probably came across it, but there's a challenge with trying to manage a property from across the country if you're in another state, building a team out in that region to manage your property, etc. So if you are going to look for these deals, especially if you're looking for those deals across the country, you have to have your team built first. So you have that human capital infrastructure to manage the properties if you're going to acquire them.
All right, so let's say that you're ready now to look for your next property, like your next really good bargain. How do you do this?
I think people underestimate the amount of information that we can get from a real estate perspective online. I think there's still an over-reliance on brokers. I think brokers definitely play a strong role in finding property still. Initially, just to get your feet wet, and studying the market, I would jump onto LoopNet. I would put in the search terms of what you can afford in terms of multifamily or single family or hotel assets, and start looking through what type of properties there are across the country. That will give you an idea of what type of deals there are, and you'll start playing in your mind how you'll make deals work. You're kind of be like, okay, if I could buy this for $600,000, I'll need to get money from this person or that person, or I'll need to get bank financing, and your mind will start working. So the first step is just go onto LoopNet and start searching.
Okay, so let's say I go on LoopNet. Okay, I found a really good deal.
Mm-hmm.
The numbers work, but the area is not so good. How do I know that I can make this work?
The first thing you need to do is jump on a plane and go visit the property. So you visit the property, and let's say that the property's in a rougher area, and it's going to be tough to manage. Well, then look, there is a market in rough areas still. I mean, people still need accommodation, affordable housing. So you gotta ask yourself the question on, is this something that you're willing to manage, and do you have a team that's going to help you manage this property? If the answer is yes, then you take next steps on acquiring the property. And basically, your business model should focus on affordable housing. Now, where a lot of investors make mistakes is they'll go through this process, acquire the property, and then it's in a rough area, and they're going to try to market and upgrade the property to a point where they're going to try and get like a corporate clientele or even a B class or A class clientele there. It's just not going to work, right? Because even if the property is gorgeous, if the area is tough, then that A or B class clientele might not want to stay there. Most likely they won't. So, you just got to be committed to the business model. And if your business model is, I'm going to go into a rough area, acquire a very cheap asset, and then provide affordable housing, you're not going to go wrong, because in those areas, that's where affordable housing is needed.
What are some of the other growth indicators that I should be looking at to ensure that, my investment will be successful in the long term?
Well, number one, I think if you're investing in C and D class assets, you have nowhere to go but up, right? So going back to the North Dakota deal, right? So we bought the deal for $450,000, $4,000 a room. You're not going to be selling it any less than that, even if you keep the hotel empty for another 2 years, most likely. You're not going to get any less than 450. What's going to help accelerate that growth is population demand in that area. So it has to be an area that is going to continue to grow. Obviously, transportation plays a key role. The local, labor market and how job growth is going. All of those play a key role. But, remember, it all depends on the segment that you're serving. So if you're serving the affordable housing segment in a small town, location is not as important. Do you have the population in that small town that needs affordable housing? Is there a need for affordable housing? And once again, going to that North Dakota example, there was a need for affordable housing in that town in North Dakota, even though the population was only 50,000. The reason being is because of the natural gas fracking boom, the rents in that area had gone up dramatically. So locals didn't have a lot of affordable housing options. And so, providing $500 a month units did really well in that market. So every market is very specific, very niche. And it's not like any other. So you just have to kind of make sure you have all of those factors in line.
Tell me some of the strategies that you use to go to the seller. I mean, if you do even go to the seller directly, tell me some of the strategies that you use to get the price that you're asking for.
The number one place to start is figure out how long this property's been on the market, because obviously the longer it's been on the market, the more motivated the seller is going to be. So I'll give you an example of a hotel that I bought just last year. I found a property that was actually taken off the market, but I had seen it as a previous listing. And I'd seen that on the listing, it said it did not sell. Okay, so the owner had self-listed and then he had self-taken it off. So I just contacted the owner and I basically said, look, your property in this area was sitting on the market for a couple of years and then you took it off. Are you still interested in selling? And he said, yes, I'm still looking to liquidate the asset if I could find an interested buyer. So I said, I'm interested. I'd love to come and take a look at it. To make a long story short, I went out, I viewed the property, I walked it with him, and I sat down with him and I said, look, he was listing the property at that point for 1.2 million. And I said, look, this type of property, it's exterior corridor. It doesn't have a franchise on it. You're going to have a hard time finding a buyer because not many banks will lend to a buyer when there's a property that's older, it's exterior corridor and doesn't have a franchise. I'm in the business of acquiring assets like this, but there's not many people out there like me who acquire assets like this. So you have a very limited buyer pool. So instead of pushing for your 1.2 million price, which you're not going to get, unfortunately, why don't we make out a deal? And the most I'd be willing to pay for this is $750,000, but I can close this deal within 60 days and I can take it off your hands and we can just move on with life. He thought about it for a couple of days. He got back to me and said, look, let's move forward with the deal. I just want to get out of this asset. A lot of times you can make deals like that a win-win. You just got to, once again, start off at what your leverage point is. And most likely your leverage point is how long it's been on the market. And if it's been on the market for a long time, reconnect with the buyer and figure out how you can get it off his hands or her hands quickly.
Do you recommend going through a broker?
There could be value in working with brokers, especially ones that have access to off-market deals. I think there's definitely a lot of value in building that network with brokers and doing that. But I also think that there is a lot of opportunity nowadays with technology just to jump onto LoopNet, to jump online and find deals yourself. But I would say, I'm at the point in my career where I've done this enough times where I don't maybe need a broker to walk me through a deal. Whereas if you're a novice and just getting into it, it might make sense to have a broker help you. But I'll also add that I think a lot of novice investors and a lot of people who buy real estate make the mistake of going to a real estate agent or a broker who is a family member or a friend of theirs. They feel obligated and they want to give, they want to give the business to their friend or family member. That is usually a mistake because it's not based on merit or what the knowledge is of the market from that specific broker. It's based on relationship. And remember, this is a business transaction. So relations and trying to help people are not going to be the best mix when you're trying to, get as much profit as possible from an investment opportunity.
You have a monthly newsletter that comes out that provides an opportunity to investors to invest in certain deals. Can you tell me a little bit more about that and what you have sort of on the table right now?
Yeah, so we are looking at a deal right now in Sarasota, New Mexico. We're looking at a 40-room motel, exterior corridor, going for $200,000. So, that's a great deal. I think, the population demand in the area is not bad. And I think we could probably run at 70 to 100% occupancy within 12 months. And once we get it to that occupancy level, the property will be cash flowing. And within, I'd say 24 months, we're going to have some very happy investors. So that's just one example of many investments we look at throughout the year. And every month within the newsletter, for those of you who want to sign up, you'll get access to what those deals are. And if you want to invest alongside Stable Gold Hospitality, the opportunity will be there.
Okay, perfect. Well, just to wrap up the session, do you have any parting words of advice for people looking for their next really good deal?
I'd say just action, make your mistakes, jump online, start looking at properties, start looking at, what type of deals you think you can afford, and start working out in your mind, how you'll be able to acquire the asset, what resources you have, either from a financing standpoint or raising capital. and then just start moving forward one step at a time. The real estate investment is a mind game many times. It's talking yourself into getting the courage to take the next step to make that investment, because you're dealing with large amounts of money. So, of course, understandably, people get nervous. Just remember that every great thing starts with the first step, and you got to take that initial step and try to make the best of any endeavor that you want to move forward with.
Okay, well, that's some great advice. Thank you for leaving us with that, and thank you, Ali, for joining us. Thank you, everybody else, for joining us and listening. We'll see you next time.
Thank you.